Welcome back to Investing Talk Podcast. Today we're taking a look at Bitfarms. It's an infrastructure company, with its feet in two worlds, digital asset mining, which we know, but also increasingly high-performance computing. Yeah, you sent over some really interesting sources detailing their financial situation, this big AI transition strategy they've got going on, and wow, the recent stock momentum is just huge. So the core question we're trying to answer for you is, looking at Bitfarms now, is this a good time to buy? Or has that ship kind of sailed after the big run-up? Before we really get into the analysis, if you find this kind of breakdown helpful, please do subscribe, like the video, and comment below. And hey, if there's a specific company you want us to look into next time, definitely leave us a comment.
Right. This company is really at quite a pivotal point. They're actively trying to shift perception, moving away from just being seen as a, let's say, cyclical miner tied heavily to crypto prices and positioning themselves more as a high-growth infrastructure player focused on AI. So the big question is, do the fundamentals, does this strategy actually support the dramatic stock price action we've just seen?
Okay, let's unpack that momentum first. It really does jump out. The stock surged, what was it, over 121% in just one day recently. And that capped off a run of like 126% gain over 6 sessions. That's not normal market movement. It signals something fundamental change in how investors see them. So what is the big shift driving this? Why such a dramatic re-rating so quickly?
What's really capturing attention is that clear, intentional pivot towards high-performance computing HPC and the AI data center side of things. The key insight here, I think, is how this changes the whole narrative. Instead of just being tied to, the wild swings of crypto prices.
Which usually means pretty low valuation multiples, right?
Exactly. Low PE multiples, valued almost like a commodity producer. Now, they're angling to be seen as part of that long-term structural tech growth story. And that lets investors start thinking about valuing them differently, maybe more on a price-to-sales basis, like other high-growth infrastructure names.
Okay, but is it just talk, or is there something concrete behind this pivot?
Oh, it's definitely grounded in something tangible. They're working to build a new competitive advantage, a moat, essentially. The sources highlight that AI and server hosting, they have much higher barriers to entry than just plugging in miners.
It's more than just cheap power, I imagine.
Precisely. You need specialized cooling, high-speed fiber connections, redundancy, and crucially, the ability to sign long-term contracts with demanding AI clients. It's a different ballgame.
So where are they actually building this capability?
The focus is very much on their new Panther Creek data campus. And you can see the commitment in the spending. They've earmarked an additional, $50 million in equipment spending specifically for this AI transition.
Wow.
Yeah, so that's serious CapEx aimed squarely at developing higher margin revenue streams down the line. It fundamentally changes the risk profile, or at least the potential reward profile. If they can execute on this, it starts to justify the kind of premium the market's suddenly giving them.
All right, let's shift to the financials then. Because the top line, the revenue growth, it does look genuinely strong. Trailing 12-month revenue hit almost $246 million. That's up nearly 32% year over year. That's definitely outpacing the industry. Shows good operational scale, I guess.
It does, yeah. That top-line growth is impressive.
But like we said, growth isn't always cheap, especially building these massive specialized facilities. The company is still reporting net losses, even with that revenue growth. So what's the real profit picture underneath, and how long can they keep spending like this?
That really is the multi-million-dollar question, isn't it? Especially for anyone thinking long-term. While they are still reporting net losses, I think for 2024, it was around $54 million. That figure was actually a big improvement, over 50% better than the loss the year before.
Okay, so the trend is positive, at least on the loss reduction front.
Exactly. The trend is towards improving margins, but yeah, profitability is still out of reach for now. And connecting that to the strategy, these ongoing losses, they really reflect that aggressive expansion. They're very clearly prioritizing heavy capital spending on those long-term growth assets, the AI and HPC centers, over showing a profit today.
Right, investing for the future.
Correct. The sources suggest they're aiming for a key earnings inflection point, where the new revenue streams start covering costs and CapEx somewhere between late 2025 and 2026.
So investors buying in now are essentially buying into a story that plays out maybe 2-3 years from now.
That's a bit, yes.
Which requires a lot of confidence and financial stability. If they're spending so much and losing money now, is the balance sheet getting risky? Is debt piling up?
That's a crucial check. And surprisingly, despite the operating losses, the balance sheet actually looks pretty healthy. That's key. Their total debt-to-equity ratio is relatively low. That gives them flexibility, which is vital in such a volatile sector. High debt could absolutely derail this whole plan.
Okay, that's reassuring.
And adding to that, their liquidity got a massive shot in the arm recently. They secured a really critical $300 million project-specific financing facility.
Ah, I saw that. Targeted funding.
Exactly. It's earmarked specifically for funding that Panther Creek build-out. Think of it as the market's vote of confidence. It basically ensures they have the cash to accelerate the expansion without taking on crippling debt, giving them runway right through to that projected 2026 inflection point. It de-risks the execution quite a bit.
Okay, let's pivot to the technicals now, the charts. Because the price action has just been wild, completely detached from its history. Stock broke way above its long-term averages. Went from under $1 at the 52-week low to over $5 recently. That's a huge swing.
A massive swing.
So what are the technical indicators telling us? Is this rally sustainable, or is it looking tired and overbought up here?
Well, the technical picture definitely confirms the strength of this uptrend. I mean, just look at the moving averages. The 200-day simple moving average, your long-term trend line, is way down around $1.37. The stock trading at triple that tells you the market perception has fundamentally reset.
Right.
And recent prices are holding comfortably above both the 50-day and the 200-day averages. So the bulls are clearly still in control for now.
But is it too hot? Is it exhausted after that run?
That's where we look at something like the RSI, the Relative Strength Index. The 14-day RSI is around 35.5.
35.5, so not deeply overbought anymore.
Exactly. That's actually a pretty constructive sign. It suggests the stock pulled back a bit from those extremely overbought levels it hit during that initial 126% surge. It implies the stock took a breather, consolidated maybe, but critically, it's not signaling an immediate, sharp reversal. Momentum seems healthy, just less frenzied.
Okay, healthy momentum. What about the analysts? The consensus seems very bullish, a strong buy, mainly on that AI pivot story, but I did see one source mention a persistent divergence. Macquarie has an outperform rating, but Weiss Ratings is still saying sell. What are the bears seeing that maybe the bulls are overlooking?
Yeah, the divergence is important to understand the risk here. The strong buy consensus is essentially pricing in the success of this AI transition. They're looking at the huge potential market size for AI infrastructure. The sell rating, like from Weiss, is likely focused much more on the execution risk and maybe the company's history.
Meaning
You're looking at the accumulated deficit, the fact that Bitfarms hasn't consistently generated net income in the past, and the sheer amount of capex needed. They might be worried about potential share dilution down the road if the company needs to raise more cash before hitting that profitability inflection point in 2026. It's basically a disagreement on whether management can actually pull off this big operational shift smoothly.
right, it comes down to execution confidence.
Pretty much.
And it sounds like the institutions, given that $300 million facility, are betting they can execute. We should also mention the management change, right? Bringing in Jonathan Meir as CFO with all that capital markets and infrastructure experience, that's seen as a positive signal for managing this big spend.
Absolutely. That appointment was seen as a significant positive, bolstering confidence in their ability to manage the financial side of this complex expansion.
And the general buzz seems strong too, right? Hearing about aggressive institutional buying.
Yes, the institutional accumulation seems quite strong lately.
And there's even some chatter, though unconfirmed, about potential partnerships with major AI cloud providers at Panther Creek.
There is some speculative talk, yes. If any of that gets confirmed, it would be a massive validation of the whole HPC strategy instantly. But for now, it's just talk.
Okay, so for you, the listener, trying to figure out timing, let's talk catalysts. What are the immediate triggers, say, in the next few months that could keep this momentum going or even accelerate it?
Right, given we're in October 2025 now, the focus really shifts to near-term events, things happening in Q4. First up, definitely the Q3 earnings release. That's probably coming up around November 12th.
What are people looking for there?
They'll want to see continued strong year-over-year revenue growth, obviously, but also, crucially, hard evidence of progress. Proof of new equipment deliveries, maybe some early, even if small, revenue contribution from the HPC AI side, a solid beat on revenue estimates, or maybe better than expected progress on reducing that net loss. That could absolutely be a positive trigger.
Okay, earnings in November. Anything else?
Second, keep an eye on more technical market events, like the S&P TSX ETF rebalancing. There's one scheduled for October 22nd.
How does that impact things?
Well, these rebalancing events can sometimes draw in extra buying from passive index funds. If Bitfarms now qualifies for inclusion or increased weighting due to its higher market cap, you might see a short-term flow of funds into the stock, potentially boosting liquidity and giving it a bit of a technical lift.
Interesting. And the longer term.
Longer term, it's really about continued strong demand from the whole AI sector, which seems likely, and potentially M&A. This sector feels ripe for consolidation, so Bitfarms could become a target, or even an acquirer itself down the road.
Okay, this all sounds quite positive, but we have to balance it. Let's talk risks seriously now. What could genuinely derail this? What are the company-specific things that could stop this growth story in its tracks?
Right, absolutely need to look at the downside. The number one risk, as those bearish analysts point out, remains those persistent negative earnings. Profitability is completely dependent on successfully ramping up that high-margin AI business. If the AI clients don't sign on fast enough, or if the build-out takes longer or costs more than planned, the market's patience could wear thin very quickly.
And that leads to the next risk, I guess.
Exactly. Capital intensity. This expansion costs a ton of money. They need continued access to capital, either debt or equity. If they don't start generating good returns on these massive data center investments soon enough, they'll likely have to raise more money by issuing more stock.
Which means dilution for existing shareholders.
Correct. Significant shareholder dilution is the big fear if they can't hit that late 2025 or 2026 profitability target. That's the consequence of failing to execute.
Okay, what else?
And finally, even with the AI pivot, you can't ignore the sector volatility. They still have exposure to digital asset prices, which can swing wildly. And even the AI data business itself, while growing fast, is still relatively new and intensely competitive. So they remain vulnerable to broader economic shifts or changes specific to the tech or crypto sectors.
Right, still carries inherent sector risk.
Definitely. So, okay, bringing all this together. Based on the sources provided, you'd probably put an overall bullish rating on Bitfarms right now, maybe around 8.5 out of 10.
High confidence, then why?
The rationale is pretty clear. They seem to have secured the financial flexibility thanks to that big $300 million facility, which allows them to realistically pursue this high-growth AI transformation.
Yeah.
It's huge. And at the same time, the technical charts are still supportive of continued near-term momentum, which appeals to traders.
So what does this all mean for you, the listener?
Well, the analysis suggests the stock could be interesting for a couple of different profiles. Maybe for shorter-term traders looking to play potential catalyst events like those Q4 earnings we mentioned, and also perhaps for longer-term investors who want exposure to the build-out of AI infrastructure and are willing to wait for that transition to fully play out.
But the key challenge, the thing to watch like a hawk, remains that accumulated deficit and the negative margins. So the final question for you to really think about is this. How much actual new high-margin AI revenue, the real proof of this pivot, needs to show up in their earnings reports over the next, say, 3 to 5 quarters? How much proof does the market need to see to be fully convinced that this transition is real, it's sustainable, and that Bitfarms can genuinely reach profitability by late 2026? That's the ultimate test for this whole bullish story.
That's a great point to end on. Thank you for joining us for this analysis today. We hope this information helps you refine your own investment strategy.